New money is being printed every single day and added to the system. But have you ever thought about who benefits from this? Who benefits the most and who benefits the least, or is actually negatively affected from this phenomenon, which is called the Cantillon effect? We're going to get into what the Cantillon effect is, how it affects people, and how Bitcoin really solves this and all the other problems of fiat as well. So the reality of money printing is that when there's new money added to the system, not everybody gets access to that money evenly. There are people that get access to it sooner than others, and therefore it hasn't actually debased the broader currency yet when the early people have access to the printed money. So if we peel this back one layer, we go to the basic fundamentals of economics, which are supply and demand. We recognize when there is two things, say they're equal, right? There's just enough supply and just enough demand. If one of these things shifts, it needs to, it's going to change the price in between, and that will drive out more of the other thing. So that's the variables, the price. So if we look at that again, we again look at the example of having two even supply and demand dynamics for one good, and that good is money. Now, if new money is being added to the system, that is more supply. So we're going up with supply. And again, in this scenario, demand is staying the same. So this offsets the supply and demand economics to the downside for demand comparatively, right? It's a ratio to the supply. So what happens there is the price goes down. So the price or the value of the supplied good goes down because relatively there's less demand compared to the supply. Now, if it was reversed, the price would go up because there's more demand for the amount of supply. So people are willing to spend more to get the supply, and that's driving the price up because it becomes a good that is rare. The money system that we have right now, we have constant new supply of currency. And in fact, there's a rate of inflation that these organizations around the world aim for. The predominant one is the Federal Reserve in America. And they talk about sort of CPI or consumer price index inflation, but the inflation of goods is a monetary phenomenon, which means that it is because of new supply of currency. That is the main driver of inflation, is money debasement. So let's just get that straight up off of the board there. So if inflation is going up, that means that there's excess supply of dollars for the amount of demand. So those dollars are getting weaker over time because of that ratio. So what we've talked about already is one thing that happens when new money gets issued, when debasement happens. It leads to currency inflation, which leads to cost of living increases and asset inflation. Now, what's interesting with that is it's not even, right? It doesn't just happen evenly. And that's what the Cantillon effect is. So the Cantillon effect is the idea that the closest to the money printer benefit the most. So when new money is issued, it doesn't get spread out evenly. It doesn't just get distributed to everybody. It's not airdropped on everyone. It goes to the people that can create the new money. So we'll get into how new money gets created, but first we'll just say that it basically flows to the people that have access to the new money, and those are typically banks and the elites. I hate that term. And then it reaches sort of ordinary people, people with less credit, less access to the money printer. And by then, the prices of things has already risen. So the idea here is it takes a while for the new money to be felt throughout the entire economy. So if prices are one thing, right? If prices are just what they are, when new money is created, that new money can acquire that thing, but that is increasing demand with this new supply because you're acquiring something. So it's increasing demand for that good with this freshly printed easy money, right? There's this idea of hard money and easy money, money that comes to individuals really easily. There's no cost of production. There's no difficulty of acquiring it. It just appears. This is easy money. And this money raises the cost of everything else, but it doesn't happen on the first purchase. It happens throughout the line on increased purchasing in whatever asset or good that those people purchase with the newly printed money. So because the average Joe doesn't really have access to this freshly printed money, they are feeling the brunt of the cost of living and asset appreciation without feeling the benefit of it. So let's talk about the winners and losers in the traditional system. So winners, I've already talked about banks, Wall Street, government, contractors. So this is because the way the new money gets issued, there's a few different ways, but largely it's from member banks being able to issue debt. When debt is issued, they don't have to back up that money or that debt by real money. They just get to create it out of thin air. Largely, that's because of something called fractional reserve lending, which means that there's a stipulation with banks where they don't actually have to have the money to back it up. They can just lend out a larger amount than the amount of assets they actually own, the amount of deposits they have. So maybe it's 10 to 1. So they can issue a $1 million loan on $100,000 of assets that they hold. So when you go to the bank and you get a mortgage for $1 million home, that money is being created out of thin air and the bank benefits from that. The bank charges you interest on something that they didn't actually have to give you in the first place. They are just creating that money and charging you interest on it. Wall Street benefits because the corporations also have the ability to issue debt. They are close to the money printer in that way. Wall Street firms, investment firms, all of this, they use a lot of debt to acquire different assets, and they are acquiring assets early. And what happens with assets, right, if there's new money going in, that's going to inflate the value of those assets as well. And they're acquiring assets as opposed to just covering living expenses like the people further down the line from the money printer. So the way that this works, right, there's sort of the winners and losers. The winners are people with that have really a lot of access to debt, cheap debt, easy debt. They have good credit scores. They might have good jobs. They might have businesses, all of this, right? They're able to get debt. The losers on this side here, maybe they just have a sort of a normal job. Maybe their credit score is so-so. It's harder for them to acquire debt, and their debt is probably more expensive to acquire. So even the access to the freshly new printed money, not just the effects of it, but the access of it is on this scale as well of winners and losers within this system. The other way that money can get issued is through the government. So the government will have a deficit. So right now there's the big beautiful bill. There's an added ceiling allotment for how much the US can go into debt and how much deficit they can have, deficit spending beyond just covering their basis. And when they have that, there's the Federal Reserve. The Federal Reserve steps in and buys the debt. So the US government issues debt through the Treasury Department, and the bond market might absorb that. The foreign central banks, regular everyday investors that don't know what they're doing might absorb a little bit of that. And the bond market's massive. The bond market is huge. So that sucks up some of that. So the government is able to issue debt and the public pays for it in some degree. Now, they don't sell all the debt to the bond market because there isn't necessarily enough demand for it, or they want cheaper rates. So if they did just sell debt to the public, they might have to increase the interest that they pay for it. So what happens there is the Federal Reserve steps in as a lender of last resort, and they act as a buyer of that debt as well. They buy all sorts of debt. They stepped in during the Great Financial Crisis, bought a bunch of mortgage debt that was all bundled together, and they hold that as an asset on their balance sheet, and they buy that with freshly printed money. The Federal Reserve, just like the member banks can issue debt and create money to the individual or to a business, the Federal Reserve can do that to a government. And it steps in and is that backstop and prints a ton of money, freshly printed money. And then the government uses that money however they see fit. So if they have contracts with private businesses, you know, all sorts of things that the government spends money on that might not be a good use of money, but they have that fresh money, and the inflation is felt from the next group of people, so savers. So just like how this inflation, this debasement, it's increasing the amount of debt, it's increasing the amount of currency. When that happens, the value of that currency goes down, and the debt is issued in that currency. So the value of the debt is actually going down as well. So another winner of this system are debtors, and a loser is a saver, because the inflation is hurting their savings. It's making their currency that they're holding as their savings worth less and less every single day. It's making debtors' debt worth less and less every single day. It has the same effect, right? So the other one here is wage earners. So wages increase, but they don't increase at the rate of money debasement, and therefore rising costs and inflation. So, you know, you talk to your parents, your grandparents, they bought a house for this, and, you know, one of them worked, and, you know, things were a little bit easier. There were challenges and blah, blah, blah. But it seemed like the cost of living was a little bit easier back then. And that's because their money at one point was way harder, and there was less debt, and there was less easy money in the system. So wage earners are affected. This next one here are the people that are the most affected. And in all of these people here, you'll see a commonality is that they're vulnerable. They're vulnerable demographics. And this is the most vulnerable within this, is the fixed income retirees. Not just retirees, but fixed income in general, whether you're on some sort of medical health kind of thing, or whether you know, just fixed income, right? If your income is fixed, it's not going to raise with inflation. And that might be a way where they can actually continue to pay out benefits, right? A lot of benefits are paid by the government. But if they inflate the currency, they're actually paying less out. They're paying the same nominally. Maybe it's even increasing nominally, but they're paying less in value because they're inflating the currency away. And those are the most, and the reason they're the most vulnerable, the fixed income individuals, is because they have no ability to fight the inflation. You know, these people are living check to check with no ability to raise the nominal amount of that check to in line with inflation. They're subjected to the fixed income provider. So here's some real world examples of massive amounts of money printing and Cantillon effect. 2008 financial crisis, banks were bailed out, the savers were punished. The banks were bailed out by the government and by the Federal Reserve. They said, we are going to buy your toxic assets. They literally created a program with the first two words of it was toxic assets. That's the TARP program. And they acquired all of these broken mortgages. They bailed out these banks. They bailed out auto manufacturers, all with the idea of not losing business, keeping employment steady and all of this. But they did so with vast majority of printed money, fresh money. And again, we already know the consequence of that. It devalues the currency units and affects the savers and benefits the debtors. I mean, the bailouts as well were just a whole nother subject because of how these companies are private businesses that profited throughout that time, and individuals profited, and then they got public bailout. I mean, it's crazy. So let's start talking about, I know we're really far into this video, but let's start talking about Bitcoin here. So fiat money, central bank controls the supply, Cantillon effect applies. Bitcoin has a fixed supply, no central authority, fair distribution. What does it mean by fair distribution? I think that's kind of the most important thing to touch on here. Yes, there's fixed supply. Fair distribution means that there is a fixed issuance. So people will talk about, oh, Bitcoin's deflationary. We can't use a deflationary currency. That's a whole nother subject that I need to make a video on. it's crazy we can't use a deflationary currency. But that shows a real fragility and vulnerability with the fiat system. If deflation is going to absolutely destroy it, why are we participating in something that is so fragile? All right. So fair distribution means that there's a supply issuance that we all know about, and the currency, the amount of Bitcoin is inflating still. But we know at what ratio, 3.125 roughly new Bitcoin is issued every 10 minutes on average. And at a certain block height, that's going to halve, and it's going to be, half of that. And then it's going to continue to halve every roughly 4 years until the 21 million max supply is issued. So we know the issuance. With fiat money that is centrally controlled and where there's all of these abilities to create debt and basically create money where there's no money backing it, right? There's all this future money, because debt is future money owed, right? It's money owed in the future, but it doesn't exist in the present. They're bringing it into the present, but it didn't exist beforehand, and it doesn't exist now. It's still just debt. It's still just debt on a balance sheet. So Bitcoin does not get created through debt, right? That's what's absolutely paramount here to understand, is Bitcoin gets created through something called proof of work. It gets created through computers, through mining computers, ASICs, attempting to solve an algorithm. And when they do, they get rewarded the ability to create a block with all the transactions that people want to send, and they get rewarded the block subsidy, the 3.125, plus any fees that people are paying to send a transaction on the Bitcoin network. So that is how it's getting issued. It is predictable, it is understandable, and it doesn't have all this nuance and like the fiat system, the way that the money gets printed. I've only talked on 2 ways. There's others too. There's other ways that new money is getting created, and there's no way to quantify it. There's all these lagging metrics of M2, M1, M3, global, US, all these different metrics that try to understand it, but has no real ability to do so. So there's so much more fiat going into the system and no way to really understand what a dollar is worth, right? This is the concept of the broken ruler. We're measuring all these goods and services and commodities and everything. We're even measuring Bitcoin in US dollars, but US dollars are not a good measuring stick. We do not know what they're worth. There's also no privileged access to new Bitcoin creation. Anyone can spin up a node and a miner and start mining Bitcoin. You can contribute to a pool and you can get a portion of that newly minted Bitcoin. You can do that. You don't have to have a certain credit score to do that. You don't have to have a really good income or a connection at a bank or what have you. You can just do that. Yes, there's upfront costs, but it's a venture to do that. It's a venture to do it. And you can easily access Bitcoin just by swapping some other thing of value, in my eyes, perceived value with dollars. You can swap that for Bitcoin and have access to this monetary network that is completely fair. So the other thing here that I'll just touch on is Bitcoin holders benefit from scarcity, not money printing. So if we understand, again, the supply demand economics, more supply of dollars, same demand, the price of those dollars are going to go down in value, right? That's the variable. Now, what we have here is we have demand going up because Bitcoin's in its adoption cycle. But even if it wasn't, if it was just staying the same, Bitcoin has this max supply that can already be factored into the price, but there's also the fixed issuance, which is very low, right? The amount of debasement that's happening to the current supply of Bitcoin is incredibly low. It's 450 Bitcoin per day, and a lot of those are just being instantly scooped up, again, because demand is outstripping supply. So what that is talking about basically is stock to flow ratio, which is one of my last videos actually talking about. It's a metric to understand scarcity. So Bitcoin is incredibly scarce. And therefore, that is one of the metrics that makes it valuable, right? If the non-scarcity of dollars brings down the value, the scarcity of Bitcoin brings up the value, right? So that's one metric to consider. Bitcoin provides an exit from the Cantillon effect. Bitcoin is a additional monetary network that is running beside the current monetary network that most of us participate in largely. It is just running on its own. It cannot be stopped, and you can decide to join it voluntarily. Eventually, it'll be the backbone. It will be the only monetary network because the fiat system, as I talked about briefly, is incredibly vulnerable. It's a house of cards. It is built on something with no value, and there is no way to quantify the value, as I said, and there's central controllers that benefit from it. And who wants to be a part of that? When you understand that, you do not want to be a part of that. You start to look for something else. Maybe there's a gold bug in your family and they say, hey, you got to buy gold. Then once you start to understand gold, then you can move to Bitcoin because it has the same fundamental properties, but it is built for the world of today. Whereas gold failed. It failed in the past at being money because it was not quick enough. And Bitcoin has final settlement and layer twos to solve the speed issue. So to sum up a little bit here, the Cantillon effect actually is part of why Bitcoin exists. It was a response to the 2008 financial crisis. It was being built in that way. There was attempts before that because this has been a pervasive problem in centuries past, but it's been a pervasive problem in North America, in the global world here for a very long time as well. So we've needed a solution. And as I said, gold is not the solution. So we needed a modern solution, and Bitcoin is that modern solution. It's not just about price, it's about economic freedom. So the reason I wanted to talk about the Cantillon effect is because it is a really clear, good example of why the fiat system is completely unfair and why we need something else. It is the antidote to the Cantillon effect, and it has done wonders for anyone who's adopted it. You just have to know that this thing is only 16 years old, and the one thing that gold beats Bitcoin on is the history. And with that history comes stability. So Bitcoin's price in the short term is not very stable. Again, we're pricing it in those dollars, and we're in its adoption cycle. So there's increased volatility, but the way you handle volatility is position size and understanding that you need to hold it for a certain length of time. Any 4-year period of Bitcoin ownership, you are nominally higher in value. You pick a top, start it at the top, 4 years later, that Bitcoin is still worth more in dollars. And that is a direct, the reason for that is because of money debasement. And again, the adoption cycle that we're in is definitely not hurting it. It's definitely helping it. But if there's no bottom, to fiat, then there's no top to Bitcoin, as I think Max Kaiser famously said. So thanks everybody for watching this video. My name's Forrest Hodel. I'm a Bitcoin coach. And if you want to book me for a one-on-one session to talk about Bitcoin, we can address your security needs, and we can answer the questions that you might not even know to ask, right? You don't know what you don't know. So you can book a link, or there is a link in the description. You can book a session with me. You can also check out all the other links I have in the description. They're all Bitcoin-specific things that you need, whether it's an exchange, hardware wallet, seed phrase preserver. These are all really important things that you need as you get into Bitcoin. A server to run a node on. There's links with discount codes and bonus, bonus rewards for signing up with using my codes. So check those out. And thanks again for everybody for watching this, and share it with your normie friends who might need a little bit of information about what the Cantillon effect is and just how much they're getting screwed by saving in their bank.